We've got Mr. Sujan Hajra, who's co-head of research and also chief economist for the institutional equities business at Anand Rathi, right here with us in the studio. Now, Sujan, as things stand, I don't think there is any positive that we can look for. What's the outlook for the remainder of the year?
Obviously, if you look at the growth is doing badly, inflation is remaining stubborn, the fiscal deficit is a major concern, your current account deficit is at record high. So from whichever way you see, there are lots of headwinds. And so therefore, FY13 is going to be an extremely challenging year in whichever way you look at it.
We do have the inflation numbers which are out on Friday. What are your expectations?
We are seeing it around 7.8 kind of level.
And what's your sense for the entire year? Do you think that inflation levels are likely to peter off in the back of the kind of global backdrop as well as the other factors that aren't working in our favor?
See, our sense is that the average inflation for the year will be, the WPI will be in the range of 8%, while the CPI will be in the range of 10%. There are several factors which are likely to keep the inflation much higher than what perhaps the market is expecting today. First and foremost, the agricultural prices are high. And if you see within agriculture, particularly pulses and oilseeds, that's basically edible oil, both the Rabi and the Kharif has been pretty bad, and this is likely to these prices are likely to continue high. Second, you have seen a significant depreciation of rupee, and 40% of the WPI prices are linked to international prices. So the depreciation of rupee will also impact. Apart from that, there are certain statistical issues. For example, there has been significant increase in electricity prices in 6 major states, and that is not reflecting in the WPI as yet. And lastly, what we think is that the level of under-recovery on diesel is unsustainable given the fiscal situation. So there has to be eventually some rise in the retail price of diesel. So all these things taken together is our sense is that the average inflation, WPI inflation for the year will be around 8%.
Right, so you've listed out a whole set of negatives largely on the inflation front, but this 7.8% number that you talk of in terms of GDP growth for the current financial year, doesn't that number seem way too optimistic?
I was talking about inflation at 7.8%. So far as GDP is concerned, we think it will be closer to 6.5 kind of a level.
And what about your sense for the capital flows? Overall in FY12, it seemed to be a bit of a disappointment. Do you think that they are likely to pick up going forward?
There is a clear possibility that the capital flow, particularly the debt-creating flows, can pick up. We are not sure about the equity flows. And incidentally, people often overlook the debt part of it. But the debt inflows in India are almost always more than 50% of overall capital inflow. And within debt, as you know, government has already increased the FI limit for GSEC by $5 billion. And our sense is that there will be further tinkering here. And this in itself, the portfolio debt in itself can result in an inflow of anything between $10 to $20 billion during FY13, so which is a significant flow. Again, if you look at the backlog of the ECB, the approval data which RBI gives on a monthly basis, it's averaging at around $8.5 billion per quarter. So that's also a significant amount which can come in. Net, our sense is that capital account surplus in FY13 is likely to be better than the capital account surplus in FY12.
Right, and in light of the fact that, there's been so much of volatility when it comes to the crude oil prices, the rupee too has been under renewed pressure. How do you see the fiscal deficit shaping up then?
The fiscal deficit aspect, we think that's one area where we have a pretty negative view. Our sense is that there will be a slippage of close to a lakh crore in terms of the fiscal deficit number, and roughly the same amount of slippage in terms of market borrowing by the central government.
And you're saying that this number is going to be driven almost entirely by oil prices?
To a large extent, the under-recovery is a major factor, as you know, government virtually hasn't provided anything for FY13 oil subsidy. But quite apart from that, there are certain on the receipt side also, government has assumed a 14% growth in corporate income tax. And incidentally, corporate income tax is almost 40% of overall central government tax revenue. Our sense is that 14% increase in corporate tax revenue in a year where the consensus is telling anything between 10 to 11% earnings growth is slightly optimistic. So there can be some disappointment on the receipt side as well.
And this 1 lakh crores that you're talking of on the fiscal deficit front, you're working on this, you've arrived at this number on the assumption that the government is not going to tinker with diesel prices in this year.
No, we are incorporating a 3 to 4 rupees increase in diesel price. Despite that, this will be the number.
So take away that 3 to 4 rupees. If we don't see that price hike come at all, if we assume that diesel prices stay where they are by the end of March, how much do you believe this?
Another 20 to 30,000 crore additional deficit.
And Sujan, given that all of the fundamental factors are stacked up against the rupee, what's your trajectory for the rupee going forward, and which do you believe is the biggest concern for it?
No, in fact, our view on rupee is that we see rupee somewhere close to 54 by October 12th, and somewhere close to 48 by March 13. The sense why we are telling that, because we will expect the current account deficit for the current year to be significantly lower than in FY12. Mostly because of two factors. One, we imported something close to $60 billion worth of gold last year, which we expect to come down at least by $20 billion this year. Secondly, also the oil prices have softened significantly from the top of close to 130. It has come down to about 98 kind of level. I'm talking about Brent, which is the real benchmark for India. So both from the oil price side as well as from the gold side, there will be a significant reduction in trade deficit. We would expect a significant reduction in trade deficit. And also in terms of the invisibles, we are pretty positive on inflows in form of private transfer. That's what is workers' remittance, and to some extent even the software exports.
But 48 is a little optimistic.
It is, but the fact of the matter is that for the last 12 months, if one call you have got right in every turn, it's a call on rupee.